Right everyone, day trading, it isn't dead and is definitely not impossible. And the real issue is you're approaching it in completely the wrong way. And in this video, I'm gonna prove it to you. And by the end, you're gonna walk away thinking, well, of course I've been losing money. No wonder why I haven't been able to be consistently profitable. Because trust me, it wasn't until I personally figured this out that I went and turned £250 into £10,000 in 1 month. Plus all of the other traders that I've taught this to, like Valerie, who went from losing £1,000 to making £15,000 in a single month following a strategy. I had Connor that went from losing £2,000 to making £10,000 in 3 months. And then we had Dan that made £48,000 profit in only 8 weeks trading. So yeah, this will be the only video that you ever need. You're finally gonna figure out exactly how to make money in the markets without gambling it all away. So let's first of all look at the reasons why you've already been set up for failure and how I can help you get over this hurdle. Number one, the only way you can day trade is to understand how volatility and risk management are the two most important things you need to use to be consistently profitable and avoid losses. So what is volatility and how does it help you with risk management? So volatility is how you measure exactly how much over the past 12 months does the asset you're trying to day trade fluctuate, so you know exactly where to place your stop loss. Now, stop losses should never be random numbers, okay? Professional traders use statistics like ATR volatility or standard deviations to know exactly where the market's moved over the past 12 months. So let's take 2 examples. Let's say you're trying to day trade the Forex markets. 2 very popular currency pairs are Euro USD and USD JPY. Now, the average volatility over the past 12 months of these 2 currency pairs, if you're using standard deviations or ATR volatility, means that your stop loss on Euro USD needs to be 0.61% because that's how much it fluctuates on average over the past 12 months. If you're day trading USD JPY, it's 0.81%. Your stop loss has to be at these levels for you to give the market a room to breathe without hitting your stop loss. If you're trying to day trade gold, the average daily volatility is 1.15%, okay? So when you're getting into these trades, you need to know your numbers to know where to place your stop loss. And this daily volatility happens 75% of the time when you're looking at a standard deviations calculation, okay? So this is hard facts and hard data you cannot argue with. Now, why is this important? Well, wherever you place your stop loss, you need to make sure you're getting at least a 2-to-1 risk to reward for wherever you place your take profit target, okay? But think about what I just said. If Euro USD fluctuates 75% of the time between 0.61%, well then how do you get a 2-to-1 risk to reward if the markets only move 0.61%? Something would have to happen for the markets to move by double the average daily volatility that happens 75% of the time. And what is it that causes the markets to move? It's the news. Whenever economic data comes out that causes the stock markets to move violently, that's when you get your day trading opportunities. Whenever some economic data that comes out that causes the currency markets to move violently, that's when you get your day trading opportunities to get your 2-to-1 risk reward in the currency markets. Otherwise, outside the days where there's no news, you're trying to get a 2-to-1 risk to reward when you cannot, because 75% of the time when there's no news, that's the daily volatility that doesn't give you your 2-to-1 risk to reward. So this is why the news is so important, because if you're trying to trade the stock markets, you need to understand that earnings expectations is what drives the value of stocks, okay? And in the currency markets, it's the expectations for what central banks are going to do with interest rates that are driving the currency markets. And the professional traders are only day trading when there's high impact news that cause volatility to increase, giving them a 2-to-1 risk reward. This only happens 25% of the time. So let's look at the current retail trader day trading trap that you're stuck in. Now, you've been educated that you can day trade using technical analysis, okay? And that provides unlimited opportunities to make money in the markets. So you can make quick and easy money because technicals predicts the market's next move. So let's logically break down what is technical analysis and why you're struggling to day trade using this strategy. So a candlestick tells you when the market's moved, but it doesn't tell you why the market's moved. And that's why technical analysis day traders find it very difficult to trade the markets. So when economic data comes out, the reason it creates volatility, currency traders are watching the economic data to understand, is the economy growing or contracting, and what's going to happen with inflation, because it's going to cause the central bank to raise or lower interest rates, and that is the key that drives currencies. And that's why if you was to ever just read a few articles of Bloomberg about the stock markets or the currency markets or the price of gold, okay, or you see hedge fund managers being interviewed, they always talk about their investments being driven by fundamentals, macroeconomics, and you never ever hear them talking about Fibonacci, moving averages, okay, or any technical analysis strategy. So let's look at the stats of the retail day traders using technicals, because the numbers don't lie. Nearly 40% of day traders cease trading within just 1 month. 80% of day traders quit within 2 years. After 5 years, the people that don't give up, there's only 7% remaining. And beyond 5 years, there's only a matter of time until they give up. Why? Because how are you going to day trade when you can't interpret the news? And that's the only times when you can day trade, the 25% of the time, because that's creating the volatility you need to get your 2-to-1 risk to reward. Because you're stuck trying to day trade the markets during the 75% of the time that the professionals are ignoring day trading because they know the volatility isn't there to get their 2-to-1 risk to reward. So you're failing not because you're not disciplined enough. You're failing because you've been giving the wrong strategy, which is never ever going to work in the markets, okay? There's not day trading opportunities every single day. There's only day trading opportunities when there's high impact news events that creates the volatility and makes the markets move. So let's look at some examples. When Donald Trump won the presidency, what happened in the markets? Bitcoin volatility spiked. It jumped up around 50%. Why? Because Donald Trump was promising regulation for crypto, which would make it more mainstream to institutional investors. That was the fundamental reason why Bitcoin volatility spiked aggressively. Now, in the stock markets, we also saw a big reaction, okay? Because Trump promised deregulation, which makes it easier for companies to grow their earnings, and earnings drives the value of stocks. And he promised tax cuts, which would also help companies grow their earnings. Again, fundamental reasons why the markets move. And in the currency markets, the dollar got very strong because Trump has been promising to put tariffs in all these other countries, which would cause inflation in America because import prices would go up and the Federal Reserve would have to react with higher interest rates, and interest rates drive the value of currencies. Now, if you was trying to day trade the markets during Trump's presidency, you was probably looking at these big moves and you was thinking, what the hell was going on? And again, you didn't understand the fundamentals about the policies driving the economy and how that impacts the markets. And that's when the day traders were jumping in based on the news, because they was predicting where the markets are going to go, because they're understanding the effect that it has on the economy. So what have we learned? Technical analysis and candlestick charts is backwards looking. It just tells you what happened in the past, and it does not tell you any information to help you predict the future. While professional traders are watching the economic data that only comes out around 6 or 7 times a month, which again explains why volatility only spikes 25% of the time, and they're using that data to get their trades on because they're predicting where the markets are likely to go, because they understand the effects of economic data on the expectations of interest rates in the currency markets or the earnings of companies in the stock markets. So you understand now that you've been basically trying to trade with a blindfold on. You're trying to drive your car, okay, to find the money, but you don't even know where you're going. You have no GPS map. While professional traders are looking at the economic data to tell them where to put their money, because they understand where the economy is going and they're predicting the market moves, and you're reacting to the market moves, but you don't know why the markets are moving, because technicals are backwards looking. Fundamentals is forwards looking, and that's how you predict market moves to be consistently profitable. So always remember this: economic data tells investors whether the economy is growing. Now, growth in the economy would mean there's higher earnings for companies, so stocks go up in value. If the economy is not growing and the earnings of companies are not going up and they're actually going down, and the stock markets are going lower, okay? And on the flip side, if the economy is growing, then there's inflation. And if there's inflation, there's likely to be higher interest rates. So currencies are going up or down in value based on where the markets predict interest rates to go, okay? It's all about predicting and not reacting. So in between the key economic data releases, which is 75% of the time, the reason professional traders don't try to day trade is because they build portfolios where they take long-term investments. And it's only when the volatility spikes that they can then become a day trader and make extra money in the markets so they can grow their returns. And that's why all the biggest hedge funds in the world are called macro hedge funds. And none of them are called technical hedge funds because they use macroeconomic data to drive their investment decisions. Think Ray Dalio, who has the biggest hedge fund in the world, $160 billion under management. He does not trade technical analysis. Think about Warren Buffett. He's always talking about fundamental reasons he buys companies, okay? He analyzes their balance sheets. He sees if they're gonna grow their earnings. Again, he's not trading technical analysis. Now, if you can name me one famous technical analysis day trader that's been on Bloomberg, that's always on the news, okay, then I would argue that you are wrong in your view, and this is why you keep losing, and you need to switch your strategy to avoid losses because no one uses this strategy. Only retail traders being educated by other uneducated retail traders fall into this trap of thinking technicals drive markets, but it's not. Fundamentals drive markets. So you need to learn how to predict the market moves using economic data and trading the news. So you can become a long-term trader that doesn't have to worry about avoiding the news and blowing your trading account. You don't have to spend hours on end staring at the charts. And most importantly, you avoid staying away from the uneducated retail day trading community, trying to think that you're going to get rich and wealthy and print money from the markets every day, day trading using technical analysis. Because day trading using technicals means you're reacting to the market moves. That's why you're always losing money. When you're day trading using fundamentals, you're predicting where the markets are going to move, and that's when you're making consistent profits. And that's exactly how to stop blowing your trading account and start making consistently profitable trades using fundamental analysis. Now, if you follow everything I've just given you correctly, there is no doubt in my mind that you are going to be able to achieve profitable trading. And after watching this video, you literally have the blueprint you need to get started. However, if you try to go ahead and implement this by yourself, it's not gonna go well. I mean, it took me around 5 years and losing up to £30,000 for me to figure this out. And while I've given you a shortcut in this video, there'll be a ton of bottlenecks and constraints that will come up if you try to master fundamental analysis all by yourself. And even worse, by the time you figure this out, you would have lost out on thousands of potential profits instead of succeeding now while the market conditions are prime for the success of fundamental traders. However, if you want to avoid the pain of missing out on life-changing money because you don't understand fundamentals, then click the first link in the description to learn more about my fundamental analysis courses. And on that page, I'm going to show you exactly how I can help you finally become a profitable trader if you've been blowing your trading accounts, you're stuck trading technical analysis, or even if you're watching this video and you haven't even got started, I'm going to help you avoid the pitfalls you're going to come up against. However, I only work with traders who are serious about mastering the markets and take massive action. And this definitely isn't for people who want to just watch more videos on YouTube and chase more technical analysis indicators. So if you're finally ready to become the trader you've always been dreaming of, click the link in the description now, check out the course details, and I'll speak with you soon. Remember, every day you're day trading is another day you're leaving money on the table. Let's master fundamentals together.